Good morning, children. Welcome back to macroeconomics class. In the previous few sessions, you were learning about the national income accounting and its related aggregates. Today also, we are continuing the same. Let's go to the topic. Children, you were learning the different aspects of national income accounting in the previous class. However, the different macroeconomic variables and its identities also must be studied. Before that, just revise what's the definition of national income. National income is the money value of all final goods and services produced in a country during a year. So, national income is equal to domestic income plus net factory income from abroad. Now, what are the different macroeconomic identities? The first one is GNP, Gross National Product, GNP. The gross national product GNP is the total value of all final goods and services produced by a country's citizen in a given financial year irrespective of their location. GNP also measures the output generated by a country's businesses located domestically or abroad. So, GNP is equal to GDP plus net factory income from abroad. Next is NNP, Net National Product. Net national product is the total value of finished goods and services produced by a country's citizens overseas and domestically minus depreciation. So, if we debit depreciation from gross national product, the amount of average earnings that we attain is known as net national product. So, NNP is equal to GNP minus depreciation. The next is NDP, Net Domestic Product. The net domestic product is defined as the net value of all goods and services produced within a country's geographic borders. It is considered a key indicator for the economic growth of a country. The net domestic product is calculated by subtracting the value of depreciation of capital assets of the nation, such as machineries, housing, and vehicles, from the gross domestic product. So, then the formula of net domestic product is NDP is equal to GDP minus depreciation. In the previous class, you have learned about, or we have discussed about, the distinction between factor cost, basic prices, and market prices, and also gross value added and all. So, now you have to learn about the production tax and product tax also, or you have to understand what is the difference between these two, production tax and product tax. Before that, we just go through what is gross value added. Gross value added is the value of GVA, is the value of total output produced in the economy less the value of intermediate consumption. What is intermediate consumption? That is the use of intermediate goods of a firm purchased from the other firm for making a good. That is intermediate consumption. So, the GVA, that is gross value added, is the total value, the total output produced in the economy, that is GVO, gross value of output, that is the value of total output produced, means the gross value of output minus value of intermediate consumption, that is the gross value added of a product. Now, let's check what is production tax and product tax. Production taxes and subsidies are paid or received in relation to production and are independent of the volume of production, such as land revenues, stamp duties, registration fees, etc. So, the production tax, if there is a production, or if you are producing or manufacturing a good, there will be a production tax that will be imposed to you. So, that is production tax. The examples for production taxes are land revenue, stamp duties, registration fees, etc. But product tax, in product tax, we are paid product tax or received it per unit of product. That is, the tax which are paid per unit of product is called product tax. Examples for product taxes are excise tax, service tax, export and import duties, etc. So, these are the difference between production taxes and a product tax. So, you will get the net production tax is equal to production taxes minus product subsidies. Subsidies are provided by the government. It's a grant by the government to the firms. So, you will get the net production tax. You don't get confused. You will get production tax is equal to production tax minus product subsidies, whereas Net product tax is the difference between product tax and product subsidies. Just check, children, the net production tax is the difference between production taxes and product subsidies, and the net product tax is the difference between product tax and product subsidies. Now let's check how we will get GVA at a basic price and market price. Before that, you just go through these things, because factor cost include only the payments of factors of production. It does not include any tax. Then the market price, at the same time, it includes factor cost and also total indirect tax, but there is a less of subsidies. But in the basic prices, it include production tax but not product tax. So when we think about the market price, we have to add the product tax, because in the basic price there is no product tax. So in the while calculating the market price, the product tax should be added to the basic price. So we can say that gross value added at a basic price is equal to GVA at factor cost plus net production taxes, and GVA at market price is equal to GVA at basic price plus net product tax, net product taxes. Children, let's check this table. The national income aggregates calculation are mentioned here. First one is GDP-MP, gross domestic product at market price. GDP is the market value of all final goods and services produced within the domestic territory of a country during a year. All production are done by the national residents or non-residents in a country gets included, regardless of whether the production is owned by a local company or foreign entity. So GDP MP is equal to, this one you have already learned in the second part of our lesson, that is through expenditure method, how the GDP is calculating through expenditure method. That is, GDP MP is equal to C plus I plus G plus X minus M. C stands for consumption expenditure, and I gross private domestic investment, G for government consumption and gross investment, plus X minus M means the difference between export and import. So this is the definition of this is the equation of GDP MP at market price. So GDP MP is equal to C plus I plus G plus the difference between export and import. The next is GDP FC, that is gross domestic product at factor cost. GDP at factor cost is gross domestic product at market prices less net product taxes. So market prices are the prices as paid by the consumers. Market prices also include product tax and subsidies. The term factor cost refers to the price of products as received by the producers. Thus, factor cost is equal to market prices minus net indirect taxes. Next, we are calculating how to get the national net domestic product at a market price. NDP, net domestic product, is the money value of all final goods and services produced inside a country's geographical borders. Whatever produced inside the country's geographical border, that is NDP, net domestic product. So we will get net domestic product is equal to GDP minus depreciation. So we will get a net domestic product at market price is equal to GDP MP minus depreciation. We will get NDP is equal to GDP minus depreciation, but NDP at market price we will get GDP MP minus depreciation, same as net domestic product at factor cost. NDP FC is equal to NDP MP minus net product tax and net production taxes. This net product tax and net production tax, all these two categories we have discussed earlier. So you just go through, then it will be helpful for you to get how we will calculate NDP at factor cost. Next is GNP, gross national product at a market price, and a gross national product at a factor cost. GNP is the value of all final goods and services that are produced by the normal resident of India and is measured at the market prices in a year. GNP refers to all economic output produced by a nation's normal residents, whether they are located within the national boundary or abroad. So actually in this GNP is included net factor from abroad. So we will get GNP. GNP is equal to GDP plus NFIA, that means net factor income from abroad. So in this GNP, net factor from abroad is included, but at the same time GDP is excluded NFIA. So you will get GNP is equal to GDP plus NFIA. At the same time you will get GDP, that is the difference between GNP and NFIA, that is GDP is equal to GNP minus NFIA. But GNP is equal to GDP plus NFIA because GDP exclude net factor from abroad. At the same time GNP include net factor from abroad. Then if you are deducting the net product tax and net production tax from the market price of GNP, you will get the GNP at a factor cost. So GNP at a factor cost is equal to GNP MP. GNP MP means GNP at a market price minus net product tax and net production tax. So you will get the factor cost, GNP at a factor cost, after deducting the net product and net production taxes from market price of GNP. Next is net national product at a market price and factor cost. NNP, net national product at a market price. This is a measure of how much a country can consume in a given period of time. NNP measures output regardless of where that production has taken place in domestic, whether it is domestic territory or abroad. So NNP is equal to GNP minus depreciation. Depreciation is the consumption of fixed capital, that is the normal wear and tear. If you are deducting this depreciation from GNP MP, GNP will get a net national product. So same time as I told you before, we will get net national product at a factor cost. How we will get? After deducting the net product tax and production tax from market price, we will get a net national product at a factor cost. Same as GVA, gross value added at market price, that is GDP at market prices. GVA, that is gross value added at a basic price, is equal to gross value added market price minus net product taxes. Then GVA at a factor cost, same GVA basic price minus net production tax. So all these are the different macroeconomic variables we are using in the national income accounting. When we go through some calculations or examples, you will understand how we will get the figures through these equations. Children, see this table. In this example, various data are given. The equation for GDP calculation is, what's the equation for calculating GDP through expenditure method? That is C plus I plus G plus the difference between export and import, that is X minus M. So here C is 200. C means the consumption expenditure. And then I is 120. What is I stands for? Gross private domestic investment. We added 100 plus 20, that is 100 plus 20 is equal to 120. We are adding depreciation to get gross investment. Here they provide 100 for net domestic capital formation and 20 for depreciation. So we are adding both 120 for getting the gross value. The G is 300. G means government final consumption expenditure. Then the difference between export and import, that is net export, is equal to 80. So the GDP at market price is equal to private final consumption expenditure plus government final consumption expenditure plus gross domestic capital formation plus net export. That means 200 plus 300 plus 120 plus 80 is equal to 700 is the gross domestic product at market price as per this data. Then how we will get factor cost at a GDP? That is GDP at market price minus net indirect taxes. That is 700 minus 10. The given number is 10 for net indirect taxes. So 700 minus 10 is equal to 690 crores. This is how we are calculating GDP, MP and FC through the expenditure approach of GDP. Children, we are continuing the lesson with more exercises in the second video. Watch today's second session video also, okay?